Hello, everyone, and welcome to today's webinar. My name is Lucy Heavens, and I am VP of Marketing at Hokodo. Over the next 30 minutes, we're going to be taking a look at the importance of credit scoring within trade credit. So this is actually part one of a 6-part webinar series where we're going to unpack the whole kind of end-to-end digital trade credit process. So a couple of quick housekeeping points before we start. Firstly, the format for today's webinar is a panel discussion. So I'm going to be having a chat with my expert here today. We've allowed plenty of time for questions, so please do send them in and we'll address them as part of the conversation. And then lastly, a recorded version of this webinar will be available and sent directly to your inbox after we've finished. So to set the scene here, many companies supply goods and loans and services based on business and trade credit, either invoicing customers for payment at a later date or providing B2B loans, for example. Business credit risk management assists companies with lending decisions based on a company's financial health, as well as other parameters that may indicate how likely they are to pay on time. So providing the right amount of credit will reduce the risk of late payments or defaults, which will expose the vendor to any further financial risk. So let's dig into that a little bit more and get started. Olivier, can you introduce yourself, please, and tell us how you became a credit risk expert?
Hello, so my name is Olivier. Thanks, Lucy, for this introduction. I joined Hokodo 3 years ago in February 2020, just before all the COVID stuff we had. And before that, I spent most of my career, so something like 12 years, in credit risk, mainly short-term credit risk, as I spent almost 9 years in a credit insurance company in France, dealing with risk in France, Northern Europe, and out of Europe buyers who were buying goods from Europe, and we just care of will they pay. So basically, credit risk in our world in BNPL is with our customer will pay us. How I came to that, in fact, it was just my first job as a credit analyst for an automotive constructor.
Well, you mean you didn't always dream about being a credit risk?
Not really. It was not my dream of my dream when I was a child, but it was my first job. I was always interested in how economy work, and this was one of the entry points to see how economy works, how firms behave, grows, and so on. And yeah, that's it. And after that, we 12 years in a credit in this at Renault, and 9 years at a credit insurance company, and then Hokodo. And why Hokodo? Because mainly it was just about doing that I did in the previous 12 years, but very, very differently.
Okay, interesting. Thank you. Okay, well, let's dig into these questions then. So I'm going to start off with there was a research report by Juniper Research, and they said that estimations, so between 2021 and 2025, they estimate that losses from online payment fraud will amount to $206 billion, massive. But it's not all about fraud. Can we kind of unpack a little bit what credit scoring is and why it's important in the world of B2B buy now, pay later?
Yeah, that's right. Fraud risk, I mean, non-payment risk in B2B is obviously a big concern for a company, but it has to be split between fraud and credit risk. So if we really focus on credit risk, it's you care about the capacity of your customer to pay its debt and financial obligation on time. As we mentioned earlier, we care about short-term credit risk because we are in the daily cycle of life of a company where they buy goods, transform, and sell it. And so it's a matter of weeks or months. So when you open the credit for one of your customers, you open the length of the credit will be 3 months, 1 month, 2 months, 3 months, eventually 4. It's a bit long, but it's doable. And so credit scoring is a measure of this credit risk. So it's a measure on how likely my customer will repay me on time or in a reasonable delay. And that's the credit risk, and the credit score is a measure of this. So credit scoring in BNPL measure how likely your customer is able to pay for the goods or services you provided. And at the end, what you want is avoid the fact that the buyer, your customer, won't pay you, or the fact that he may pay you very late because you will need to chase him again. And for you, when you wait for like 10K, 15K for months, it's very damaging for your cash management. Also, there is another thing that is interesting in credit scoring is that when you start working with a customer and with a good credit score, you can say, okay, this guy, maybe it's interesting to invest in because I can see a big potential. He's a reliable partner from a credit scoring perspective. And so maybe I will prefer to invest resources in this reliable customer rather than on a smaller company with a bad credit score.
Yeah. I have a question around kind of the how the credit scores are sort of put together and how it's different between B2B and B2C. So, or is it the same? Is it the same that, because obviously in kind of the B2C world, you know, when you are offered credit by companies and then you pay on time and you build up a good, a good score as a good payer. How does it work kind of in the B2B world?
B2B and B2C are different for several things. First, the size of the order. Usually, an individual wants order for 500K of goods for something. So in B2B, you have to deal with larger credit exposure.
Yeah.
And then after, another difference is obviously that you have more information about the company. You have more available information. Obviously, you need to look for that in the right place, because for a company, file its financials, profit and loss accounts, balance sheets. You may have also access more and more to their bank statements through open banking solutions and so on. So also all legal filing are available in most of the country. I mean, there are differences between countries, but if we group country, Western Europe country, more or less, you have access to the same information, not the same way, but you have access to the same information.
Yeah. Okay. Interesting. Thank you. So if a B2B firm offered deferred payment options manually, so what do we mean by that if they're offering it manually? And then the second part of that is, how do they then credit score a customer? When I say manually, sorry, just to clarify, I mean kind of off their own books.
Yeah. There are several ways to manage credit, how your credit with your customer. First, you can have a policy like every new customer has to pay upfront for 2 or 3 first orders, and then after you can open the credit tab. It's not ideal because more and more in a relationship in B2B, you want the payment terms is part of the negotiation. So it's not ideal. Then after, effectively, a company could build its own credit score and say, okay, I will collect some information about this customer. As I said, there are available information like the incorporation date, its activity, the directors, the shareholders, financial, and so on. It's all available, but it's not easy to access it because you need, for example, in France, financials are not profit and loss and balance sheet are not available for anyone. You need to be, you need to have an account at Infograph, and I think everyone cannot have access to that. So, first, the first issue will be to collect the data you need, the information you need to credit score a company. Then after, you have to build your logic. How based on the information that you collected, how you give a credit score. Why do you care? Why do you really care about when you deal with your credit score? Is it payment experience? Is it the age of the company? The older, the better. Is it? I don't know. You can calibrate a credit score as you want, but it's not easy. And at the end, again, what you want is avoiding any loss. So it's not really easy to do. It's doable, but it's not easy to do.
Yeah, I can imagine. It's an interesting point, actually, because I read a report, another report that said that 74% of organizations struggle with credit risk strategy as data is not easily accessible, which is basically what you just said. And the same survey said that 74% are planning to invest in real-time credit decisioning platforms. So, you know, they're looking for ways to easily get that data in kind of a presentable format rather than trying to sort of manually look for it themselves. So let's kind of unpack that a little bit then. So what are the difficulties in building your own kind of credit model internally, or maybe sort of buying external scores from, you know, companies like Judo and others?
So first, collecting information is the first issue because you need you can buy all the information from external data provider like the ones that you mentioned, Udil, Elisphere, but it's not for free, obviously. Otherwise, you can have access to free information on the internet. In France, for example, you have resources like INSEE or Bodac in France. I think they are free. In the UK, you have access for free to the company house where you have many information. But when you are a company dealing across several countries, you have to do that for every country, define a process to collect the information for every country. So that's one of the first issues. Then you need to update this information regularly because the situation, the creditworthiness of a company evolves in time. It's not the same. Creditworthy company in January 2023 may change, may have difficulties in 2023, and January 2024, the situation may be worse than 1 year before. So you have to update it. So again, something about collection of information. And then you need to compute this data and build your model. What's your recipe? What do you really care about? And is it appropriate? Is the age of a company really reliable to assess the creditworthiness of a company?
Yeah.
It may not. And in reality, you don't really know. And that's what we do at Hokodo when we build our credit models. We check if this feature is a good indicator of the creditworthiness of a company. And we do that for many, many features. And at the end, we take the best features that indicates the creditworthiness of the company.
Yeah.
And
okay.
at the end, once you have built your credit model, you have to convert it into a decision of credit.
Mm-hmm.
So if your, let's say your credit model is gives a note from a score from 0 to 10, where 10 is the best. When do you start to open the credit? Is it at 5, 6, 7, or only the best 9 and 10? And so say it's your policy about what risk appetite I have.
Yeah. And you said something really interesting there as well. It's not just one decision on whether you give them credit. It's this almost like this ongoing continuous decision-making process, because you're on, always having to look back at that data, because it, obviously situations change. And yeah, that's interesting. So what are the benefits of kind of having that instant decision-making ability?
Well, I think at the end, the main benefits, it's an optimized user experience for your customer, because the sales process is short-term. Let's say you have a customer coming to you wanting to order for 15K of goods. If you, in your negotiation, as I mentioned, the payment terms is part of the negotiation. If in your discussion with your customer, you say, okay, you want 15K, I need to check if I can let you pay in 30 or 60 days. So you go back to company's house, Gazette, and collect all your information. It takes some hours, sometimes days. You decide to open the 30 days payment terms. Okay, cool. But still, are you sure you collected all the data, the information that you need? Whereas in a real-time decision credit score, like what we do at Hokodo, we are plugged to company house, Gazette, Infograph, and several data data provider, where we are being 100% sure will be is not possible, but at least 99% sure that we have the freshest information in our decision engine. And so we are sure that giving 30 or 60 days relies on a decision that is properly documented, properly populated. And so when you are discussing with your customer about this 15K of goods, if you have a real-time decision where, okay, you can pay in 30 days. So that's, okay, so now this part of the discussion is done. Next discussion, price, whatever.
Yeah, exactly. Well, there's no, yeah, I think in today's world, everybody is, you want instant decisions straight away, don't you? You can open a bank account in 5 minutes now. You can, you can purchase and pay for things instantly. Nobody wants to be waiting 2 weeks, for a decision on whether they can have credit or not. So let's have a look at Hokodo. Let's dig into our solution. How does our scoring model work, and how do we decide whether to give credit, 30, 60, 90 days credit to an organization or not?
Yeah, let's dive a bit in our models. I have a slide that we can share so that it will be easier to demonstrate.
Let's have a quick look at that.
Please.
Here we go.
So this is a basic chart explaining from what we collect, what we analyze, and what is the conclusion. So the first part, as we already mentioned, is data collection, and you can see that from public sources. It doesn't mean in reality that it's available for everyone. You need some to be granted with access and so on to and so from public sources we can collect legal filing of a company, directors that are incorporation information like the date of incorporation, the status, the legal form, and so on. We can collect financials from which we will compute financial ratio, like one of the current ratio, margin, and so on. We collect also information from the shareholders, because assessing the creditworthiness of a company is different when the company is a standalone company compared to a company integrated in a group like Tesco Group or whatever. We also compute our in-house data, like what is our current exposure on this buyer, what is the status of this debtor, what is the payment experience we have with them. And based on this, we have an exclusive information of the behavior of the debtor, of the buyer. And then also, we also collect private data from our merchant or from the buyer. The merchant can provide us with some information about this customer, like if this buyer has a special statute with this merchant, like he has a special subscription, or even they can share the payment experience they had before starting working with us. And also, we can dialogue with the buyer to collect more information that we couldn't collect anywhere else, like open banking, through open banking solution with bank statements, also management accounts that we are able to ingest and integrate in our analysis. And so from this data that we collected, we process our analysis of the creditworthiness of the company. So we will compute our probability of default. It's basically the real credit score, where we say how likely the buyer is going to default. We also compute a limit because based on the size of the company, based on the probability of default, we will say, okay, it's reasonable to take a limit, to have an exposure maximum at 20K, 30K, 100, 500,000, something. And some what we call the underwriting rules, because a very basic one is if the buyer is overdue by more than 15 days, maybe it's not a good idea to open the tap again and just make sure he pays first his old order, and then after reopen the credit tap. So we have a set of underwriting rules that we compute each time we want to open payment terms. And from this analysis, we decide yes or no if the allowed to pay in 20, 60, 90 days.
Okay, thank you. I'm going to come out of this screen. There we go. Fantastic. Okay, so what, finally then, just let's have a look at what techniques that Hokodo use to help buyers to increase their credit limits. So you mentioned about them starting off maybe with a certain limit, and then after time that it can be increased. You know, how can buyers help to increase their limits?
So yeah, the first, so there is a kind of basic limits that we compute for a buyer the first time we see this company. And this limit can improve over time based on their payment experience. If they are a good payer, they pay on time, we will be very happy to increase their limit and let them order more within this limit. So payment experience is one of the probably the most powerful leverage to increase the limits. Then after, we also propose we can propose open banking solution. I mean, collect bank information through open banking. I don't know how much it's common. It works pretty well, at least. And so the buyer can, well, you see, there are some companies like small businesses, young businesses, so this these companies may want to privately share some financial information with us so that we can improve their eligibility and their limits.
Okay.
And we can collect this data through open banking.
Oh, Olivier, sorry, the connection's not. Could you? Sorry, the connection is not particularly great at the moment. Would you just repeat what you just said?
Yeah. So we can collect data through credit decisioning engine, and then after we are also able to do some manual work. We have our automated decision engine, but this engine can be by some manual work, and so our credit team may override the automatic decision based on some information that needs special treatment. Like some information that are in the newspaper, like an announcement of a fundraise of a startup. It's not easy to ingest in a credit score model. So, however, a credit analyst can take it into account and override the automatic decision. And also, as we saw in the chart, we can integrate in our underwriting engine merchant data.
Yeah, absolutely. Which is one of the biggest benefits, obviously, with working with a company like ours is the fact that you have the experts that are making those informed decisions, taking that kind of responsibility or pressure, I suppose, away from the merchant having to make the decisions about what credit they offer to their buyers, right?
Yeah, absolutely.
Yeah.
At the end, having all these solutions available in real time will free a lot of the time of the company, of the merchant. There will be, okay, Hokodo manages the credit risk. They will pay me and they will collect the money. And that's, I think it's a big benefit for the manager of the company. Yeah,
absolutely. Okay, perfect. Thank you. I think we're just coming up to time now, so we'll wrap up here. But thank you so much for joining, Olivier, and sharing that information around the credit risk and how kind of Hokodo works. We have, like I said at the start, this is a part of a 6-part series of webinars where we're unpacking each of the kind of stages of the trade credit process. So please tune into the other episodes. But thank you very much, and thank you everyone for joining, and enjoy the rest of your day.
Thank you. Bye.
Bye.